So yeah, let's get started. So after a small summer break without any monthly webinars, we're glad to finally welcome you back to another series of webinars by DigiShares, where we'll be covering different aspects of security tokenization. My name is Jonas, and I'm today's host, and today we'll be focusing on decentralized trading of tokenized assets. And to shed light on this topic, we have invited industry-leading experts who will help you or us better understand the world of decentralized trading and how decentralized exchanges help bring liquidity into security token markets. But before diving into the topic of decentralized trading of tokenized assets, let us just briefly cover the rules of engagement. So first off, if you have a question for a specific speaker while he or she is on, please add that question to the Q&A. And please also remember to specify who the question is for. So simply type in the name of the person, followed by the name, followed by a question. And then after each presentation, if there's any time left, we can then take a few questions. And if not, we'll try to save them for the panel at the end. And please also note that sometimes if our speakers have any time to spare, they'll enter the Q&A after the presentation to answer your questions. And if you have any general inquiries, feel free to use the chat. Our moderators will sit ready to answer your questions. So yeah, please do that. So and also the last thing to mention, if you have any technical issues during the webinar, such as speaker being muted, screen not being shared, anything like that, please feel free to notify us using the chat. Okay, so having covered the rules of engagement, let us now move to an introduction of today's presenters. So first off, we have Klaus Goning. Klaus is the CEO of DigiShares, and he'll be giving a tokenization industry status update and talk about the current traction of DigiShares. Following Klaus, we have Jeffrey Bennett, a software engineer Balancer. He'll be speaking about building on Balancer and present a decentralized trading use case. After Jeffrey, we have Derek Acton from Constrio. And then after Derek, we have Mark Dencker, who's the CEO of RealEstate.Exchange, and he'll be talking about decentralized trading of real estate assets. After Mark, we have Julian Kwan from IXSwap, who will be presenting IXSwap's perspective on decentralized trading. And then after Julian, we have Philipp Pieper, the co-founder of Swarm Markets, who will be talking about Swarm Markets and its relations to decentralized trading of tokenized assets. And yeah, then after that, we have Niklas Reichert, sales director of Fireblocks, who will be speaking about Fireblocks and their view on decentralized trading of tokenized assets. And then finally, at the end, we have Derek Boirun, CEO of Realio Fund, and he'll be presenting Realio's perspective on decentralized trading. And then, as usual, at the end of the webinar, we'll have a fireside chat where today's presenters will answer some of your questions. So yeah, if you have any questions you'd like to ask the panel, please feel free to post it in the Q&A. And also, again, please add panel followed by a question. And if the question is for a specific speaker, then please write who that speaker is. So simply type in the name of the speaker followed by a question. Okay, so that's the program of today. And now I'd like to present today's first speaker, Klaus Goning. And Klaus has a PhD in computer science, specialized in AI, and has taken out 7 patents. He's a serial entrepreneur, having co-founded more than 5 companies so far. And for the last 5 years, he's been focused on blockchain, and he has also co-founded DigiShares 4 years ago. And Klaus will now give us a tokenization industry status update and shed some light on the current traction of DigiShares. So yeah, Klaus, the stage is yours.
Thank you very much. Welcome to everyone here today. My name is Klaus. I'm the CEO of DigiShares. And of course, we are a provider of white label platforms for real estate tokenization. We've been doing these webinars for quite a while now. I think it's number 7 or 8 today. The purpose has always been to educate and motivate try to pull the industry together to make it easier for outsiders to understand what we are doing, to show real use cases, to show what value we can bring, and help, of course, expand the market for us, or for the industry here, for us players in the industry, into the mass market and make it bigger for all of us. Today, the focus is on decentralized trading of securities and particularly of real estate. And I think it's the first time we've brought together such a group of experts on this particular topic here. Our perspective is that it's that decentralized trading, at least trading that is decentralized to some degree, is better than centralized, or at least it's another strategy into to try to make trading happen in the real estate space, which is of course extremely illiquid and has been illiquid for many years. We think that the decentralized approach, the DeFi approach, gives some advantages over the centralized approach. So it's more lightweight. It's possible to manage an exchange in a less expensive way, making it less expensive also for companies who are listing and for people who are trading. It's possible to bootstrap liquidity. It's possible to purchase and build liquidity in a more granular fashion. And there's a number of benefits that I think will be highlighted today. The trend, if you look across the space, is clearly going towards decentralization. So there's also something that indicates that decentralization is essentially better than centralization, at least on longer term. But we will see. So we have a really packed program today with many top speakers. I'm really proud that we will hear from our own RealEstate.Exchange, but also from leaders in the space, Balancer, IXSwap, Swarm Markets, Fireblocks, and Realio. So it should be extremely exciting. In September, we have our next webinar, which will be focused on ESG, sustainability and impact, how to use tokenization to create more impact and more sustainable projects, and how we as an industry can have an impact on sustainability and the UN Sustainability World Goals. That should also be quite interesting. And in October, then we are looking at tokenization of debt, which is something that is not done so much, but is increasingly becoming interesting for many companies, I think. We as a company are also doing a number of masterclasses around the world. We are in Las Vegas on September the 12th in connection with the Blueprint conference, again in Silicon Valley on October the 4th in connection with the Blockchain Expo, and again in London on November the 30th, also in connection with the Blockchain Expos. These masterclasses are generally also with the purpose to educate and motivate the outside industry. So it's not for blockchain and tokenization experts, but rather for industry outsiders who are interested to learn more. In addition to that, of course, we are present at many other events with stands and keynotes. Since the last webinar back in May, we crossed the 100 client mark and keep growing as a company. So we see growing interest in tokenization from the industry, both real estate developers, real estate owner operators, but also real estate business people who are interested in developing tokenization as a kind of service in their own region or their own niche. We have recently sort of split our platform into 3 different configurations. One is a crypto-based configuration, another is a fiat-based configuration where we still retain the tokenization functionality, but that actually makes it possible for, you could say, more conservative adopters of the technology to operate, at least in the beginning, without crypto and only accepting fiat as payment. This is also particularly useful in countries where crypto to some degree is banned, like India. And then we also have a custody-based configuration where we integrate with a custodian and provide an added security. In addition to that, we will soon be offering a RegCF crowdfunding option for US clients with our platform, because it's becoming licensed under the crowdfunding regulation. So I think that's basically it for me. I'm looking forward to the presentations today, and I think that we will have very exciting few hours ahead of us. So thank you.
Yeah, thank you for that, Klaus. Okay, so next speaker up is Jeffrey Bennett, who's a software engineer at Balancer, and he'll now speak about building on Balancer and present a decentralized trading use case. So yeah, Jeffrey.
Welcome. Hear me all right? Okay, yeah, I'm Jeff Bennett, Balancer OG. I started working in mid-2020, it's 2 years ago already. It's about 14 years for dogs and crypto projects. I'm on the smart contracts team working on the core protocol, and especially the liquidity pool infrastructure. So I'll be introducing Balancer, who we are, what we do, talk about our general philosophy and perspective on the space, plans for the future, and then explain how the technology applies to tokenized real estate in particular. So let me share here. Okay, everyone see that?
Yeah.
All right, so a little about Balancer itself for those who aren't familiar. And even if you think you are familiar, you might not be anymore, because we've grown enormously, especially this year. And in order to scale up sustainably, we've split into several components with specific responsibilities. So at the core is we're a DAO, that composed of all the individual contributors at all levels. So we have what we call the maxis, who've taken on significant responsibility and devote most of their time to Balancer, and then general users just commenting in the forum, participating in governance votes, and hanging out on the community calls. And then the actual team is also divided into separate entities according to their functions, showing the two most relevant here. There's a Balancer Labs that works on the smart contracts that make up the protocol. That's where I am, and we just do open source software development. That's it. Just 4 guys on 3 continents making the magic happen. And then we have a separate DAO-funded entity called the Orb Collective, and that houses the business development, integrations, and marketing teams. So there's this kind of a funnel here where the business development generates leads, gathers requirements, and then integrations translates those into technical specs, and then helps the external teams build whatever specific things they need for their project. And if it turns out they need something like circuit breakers, for instance, that's not supported in the protocol yet, then they coordinate with Balancer Labs to get it in, and that's happening now with managed pools, and we'll see later. So that's kind of who is Balancer, and I also ask, what is Balancer? Right? It's really 2 things, or 2 main functions. It's a decentralized exchange, the topic today, and an asset manager. So we have data teams and SDK teams that maintain smart order router and subgraphs. Those are tools that are used by aggregators and UIs to interact with the system. For instance, to find the best price path through pools to exchange tokens, or deposit, withdraw from liquidity pools, interact with liquidity mining, and so on. So what are they interacting with? Interacting with the vault. And that's the core smart contract that holds all the tokens, does all the accounting, and exposes kind of simple interfaces for the 3 main operations, trading, depositing, withdrawing. It's the main difference really between Balancer and the other AMMs. With this architecture, you can write a new pool type that does anything you want, interacts with any other protocol, as long as it conforms to the simple interface. So the protocol itself is extensible. And then, so the mission is the premier provider of programmable liquidity, we call it. We've always been focused on the long term, and that's especially relevant to something like this, tokenizing real estate. That's a very long-term project. Anything that touches institutions is, it takes years. Even in the regular space, it takes years, much less, when there's all this uncertainty. So if you want to participate in the future, of course, the first requirement is to still be there when it happens. So you ride the highs and regroup and practice fundamentals in the lows. Bull or bear will always be there. And that means, has a lot of implications. It includes the business organization that I already talked about. It means having a stellar reputation and very high ethical standards. That's important, especially for the future. You're not going to find us muckraking on crypto Twitter. Just like employers these days, I'm sure future institutional partners will check your social media. They say Will Smith is the Barry Manilow of rap. we might be the Barry Manilow of crypto, but it's a good, safe place to be. And security, of course, is paramount. Anything financial, we absolutely put security first. We offer huge bug bounties and work with Immunify's army of white hats, help keep us on the ball. And the technical side, we're a permissionless platform, and that's both those words are important. So as a platform, we're not making products, we're creating infrastructure, right? We make robust, easy to use primitives, such as the flexible liquidity pools, and then other projects can use those primitives to innovate on top of it. We can't think of everything, but that's the beauty of it. We don't have to. We're not chasing trends, not aping into NFTs. We're not copying what other protocols are doing, because you never know what's going to be the next gold rush and what's a pile of pyrite, right? But that's the beauty of it. If you're the one making the picks and shovels, it doesn't really matter. And we're also not competing. It's important. We're not competing certainly not in any adversarial sense with other DEXs. We get DEX traffic because we make our pools easy for aggregators to integrate. And we don't invent our own lending service. We just encourage the existing lending platforms to build on us. We don't grow our own liquidity mining. We just use Curve and build things on top of it to make it safer and more robust. So if you want to last, don't make enemies, look for win-win solutions. It's always been our strategy. And tokenized real estate then is no different. Balancer has secure, feature-rich pools with access to deep liquidity, fine-grained control over fee structures. So if RealEstate.Exchange, for instance, can figure out all the business and legal aspects of real estate, compliant token standards, creating a UI, onboarding, authenticating, then that's a great example of something that can be built on top of what's fundamentally a permissionless platform at the lowest level. And in the world of traditional finance, I kind of liken it to Fundrise. It's a thing I like. It's a crowdsourced real estate investment platform, right? Fundrise has a website on the internet, and they offer fractionalized real estate. And in DeFi, you can think of it as the blockchain is kind of like the internet, and Balancer is, a browser with a lot of plugins. So what are we working on now? We just transitioned to the VBAL system for on-chain liquidity mining. And we're about to release composable stable pools. That's the next generation of our capital efficient boosted pools. Boosted pools are liquidity pools that do yield mining or yield farming in the background. And that was a huge effort. It entailed a pretty big refactor, actually, of the entire code base. And it paid off a lot of tech debt. And then also will benefit a lot of the work done there will translate directly into the managed pool work, which is upcoming. And that's really the most relevant to this effort of tokenizing and decentralized trading in real estate. So just to give a little scope, I won't go over in detail, of course, but mainly for kind of shock value. We went from this organization, right, with multiple base pools and 3 kinds of stable pools and Oracle madness to much cleaner, this one base, one stable, no oracles. This is much cleaner and easier to build on while gaining functionality and actually improving security. So if I get to the details then, how can Balancer technology support and tokenized real estate? So of course, safety is paramount. And one important new feature that's now common to all pools is recovery mode. So we already had a pause mechanism that would let you halt a pool if there's an incident or something goes wrong, but that only works for 3 months after the pool type is created. After that, everything's completely permissionless. So with recovery mode, it's different. It does not halt the pool. Everything works as it did before, but it just enables an additional feature. So a dirt simple fail-safe exit. So it doesn't do any fee calculations, doesn't do any external calls. It doesn't do anything that can fail. So it's an absolute guarantee that funds, can never be locked, no matter what happens. So if we have DPEGs, you have another incident like UST, Luna, or Terra, you can always get your funds out as long as the tokens themselves, as long as transfer on the tokens actually works. And another institutional support kind of requirement is fees. Right? How do you charge fees on a permissionless platform? Many ways, AUM-based, swap-based, various kinds of protocol fees. that get very complicated once you start composing pools, so you don't charge things more than once. We were jokingly calling these fee pools for a while, because there's really a lot of flexibility there. And also safety. Another aspect of safety is the controllers. So the underlying managed pool can do anything. And if you ever just deployed a naked managed pool, it would require complete trust of the manager. So we have controllers on top of the pool that control it given high-level instructions from the manager. So the manager is not directly controlling all the little parameters. He's just saying, okay, now it's initializing or funding state. Now it's in the trading state. Now it's in the rebalancing state. And maybe there's delays on those powerful actions, and maybe some features are disabled. So that way the manager is much closer to being trustless, and they can't cause loss of funds, accidentally or maliciously. You can add or remove tokens on these pools. That's the only pool type where you can do that. And that's important if you have some sort of fund and you want to replace one with another, or just add things over the time. And then part of that, of course, any sort of asset management thing requires rebalancing. And there's a lot of flexible strategies that are enabled, and you can configure it for a particular use case. So some pools might just gradually change weights every month over a few days, and others might leave trading halted normally and then only re-enable it once a quarter, and then they resume it in a certain particular way that minimizes impermanent loss. And then finally, they're circuit breakers. As far as I know, don't exist anywhere else in DeFi. That's another Wall Street-like kind of safety feature, and it guards against things like Terra Luna crash. So if something depegs and the price goes to zero, or there's a bug in the token and it infinitely mints, it doesn't let you. It halts trading of that pair or of that token with anything else, while allowing the rest of the pool to function. So it's a little bit like the trading on Wall Street, where you halt it under extraordinary conditions, and it just preserves capital. So, I guess in your case, if the building burns down and the token goes to zero, it halts trading on it, and everyone can just withdraw. So that's, I'm not sure how I'm doing on time here. That's what I had for the technical part of it.
Okay, great. Thank you, Jeffrey. I don't know if any one of you have any questions. So we do have 5 minutes left. So if you have any questions, please feel free to add it in the Q&A. But yeah, in the meantime, Jeffrey, let me just put on my camera here. I think it would be good to know what you think are the main hurdles for mainstream adoption of real estate tokens, and especially in terms of liquidity.
Right. Well, I mean, it's similar to the hurdles of mass adoption in general. There's and certainly institutional support. So there have been some barriers traditionally to institutional support. The biggest ones, of course, are the legal and regulatory things, and that's been very challenging. And also just in usability for the end users, and also just safety and security. It's because they have without a lot of the new protections that we're developing, it would be possible, for instance, if you have 20 tokens in a pool, one of them might go crazy, and then if you have half $500 million in it, the way AMMs work, it's possible in some cases if one of the tokens goes to zero that you can just drain the pool, and that's not acceptable for an institutional kind of player. So that's why we have those sorts of features, and also trust. There's trust issues, because the big difference with DeFi is it's non-custodial generally. Basically, you've got tokens, whatever you're paying with, and you're just swapping tokens within your wallet. It's not like Vanguard, where you're sending it to Vanguard, and you're kind of trusting them. And there's no, but Vanguard's a legal entity that's subject to direct control or regulation, and that's not the case in DeFi. So there has to be some guarantees of trust in a different sense. Yeah, and that is like the controllers, right? So that you can look and see that the manager can't steal your funds. But it also things like the CeFi collapse highlight how actually it's actually like in the recent collapse, it was the centralized things that failed, because the centralized, they make promises to users, but in the end, they don't really have to honor it, because they've got custody of your funds, and they can make backroom deals and say do whatever they want. Whereas the DeFi platforms in this thing, they just worked automatically, right? They're smart contracts. When the price dropped, they liquidated, period. You can't call them up and say, hey, don't liquidate me. It just happens, right? There's nothing you can do about it. And that's how that's an element of the safety. You know how it's going to work, and you can't renegotiate or change the rules in the middle.
Yeah, makes a lot of sense. Okay, so I see there's another question here. Are there any current efforts to comply with KYC and AML? This should be relevant for institutional investors.
Well, yeah, that's again, we're the permissionless protocol on the bottom. So yeah, that we don't deal with it with that. We just do, like the Balancer Labs especially just does open source software development. We just make the infrastructure. Yeah, that's kind of the responsibility of all the people building.
Yeah.
So that's the secure token contracts, and there are some, and that's an ongoing discussion, and it is very long term. It's possible that we might have to have a different, a segregated vault, or something like that in the future. It also depends on the jurisdiction. So yeah, Balancer itself doesn't really can't really deal with that.
No. Yeah, that makes sense. That makes sense. Okay, so actually, I think that's about it. But thank you so much for your time, Jeffrey, and I assume we will see you later at the Fireside channel, Fireside Chat. Thank you for your time. Okay, so yeah, next speaker up is Mark Dencker. Mark Dencker is the CEO of RealEstate.Exchange, and he's also the head of blockchain here at DigiShares. Mark is a digital native, an entrepreneur, and a blockchain enthusiast. Working with software development since the age of 12, Mark has experienced firsthand how software can change the world for the better. As an entrepreneur, Mark has held active roles in different software projects, with the latest being RealEstate.Exchange. And now Mark is here to tell us more about RealEstate.Exchange. So welcome, Mark.
Thank you. And thank you for that introduction, Jonas. And thank you, by the way, also to Jeff to come on among other partners. It's great to see you guys here. I speak to you regularly, but it's great to have everyone else see who is actually making all this happen that I'm going to talk about in a second. But before I dive into what RealEstate.Exchange is and all that, I just want to take a step back a bit and give some perspective, perhaps, because right now crypto and the state of things is a bit weird, if you ask me. Like, we don't know if stable coins are really stable. We don't know if the Ethereum merge will go well or not. It's scheduled, I believe, in 16th of September, so in a month. Moving from proof of work to proof of stake, which is exciting. It's been anticipated for years now, but we don't know exactly how things will go, right? We don't know if the market will go up or down. Like, people are talking about we're out of the bear market. Some people are talking about we're entering new lows very soon. And then finally, almost recently perhaps, we don't know if our wallets will get blacklisted all of a sudden because the US Treasury just sanctioned Tornado Cash and perhaps will sanction other dApps. So anyone who ever interacted with smart contracts from Tornado Cash will get blacklisted. So there's just a lot of things that we don't know, and a lot of uncertainty in today's world, it seems, especially in crypto. It's all up in the air, really. And I think more than ever, also more than when we started RealEstate.Exchange, we need something that feels safe, at least. And historically, that has been for people to have a roof over their heads and a real estate that they can always rely on, really, in their lives. And that's what we are here for. I mean, when you look at what people typically put the majority of their net worth into, it is typically a house or an apartment or whatever real estate they might buy. So why should it be any different on blockchain and in crypto? Especially in a time when stable coins are not always as stable as we thought. It seems like people need another safe haven, and that's what we want to present to people. So with that out of the way, now you know the importance of what we are doing, I guess. I just realized that I have a new computer today, and I didn't allow Zoom to share my screen, so I can't show anything to you guys. But I think anyways that Jeffrey did a great introduction and rundown. So stealing a bit my thunder there, Jeff, but that's okay. You know a bit more about the technicalities now of the inner workings of what we are planning to build. But essentially what RealEstate.Exchange is trying to do is to be an aggregator. We want to build obviously an ecosystem, but basically a UI, RealEstate.Exchange, that is powered by a bunch of liquidity pools via AMMs like Balancer and other AMMs in the future, which we tap into. Now, why is that important? It's important because others have tried to put real estate on the blockchain. And most people that have tried to do that, they basically forked something that existed already, Uniswap or whatever protocol DEX out there. And that's fine if you want to launch something real quick. I mean, it's, you know, copy pasta, as I like to say, is always the fastest route to launch anything. But the problem with that, especially when it comes to real estate assets, because real estate, as we know, are typically bigger ticket sizes, bigger investments, and it's a very illiquid investment. So the problem, of course, becomes liquidity. How do you, like, one thing is having something work in theory, but does it work in practice, having liquidity enough for the user not to experience crazy amount of slippage and trading fees, basically? And that's the problem that all these competitors that we face have learned the hard way, I would say. So we take another approach, and what we do is we partner up with existing AMMs, DEXs out there, who has a lot of liquidity locked up already, which means when we issue a real estate token, then they will be issued and added to a pool that is tied into a protocol that has a lot of liquidity already, and hence maximizing the likelihood of creating a liquid pool, and hence lowering slippage and trading fees. So that's been our approach since day one. It's not always the fastest approach, but as someone said, sometimes if you want to go fast, go alone. If you want to go far, go with others. And that's exactly what we're doing, really. To do that, we need our own token, because you might think, okay, sure, you're partnering up with existing AMMs and protocols, that's all fine. But right now, so let's take Balancer, for example. We just heard from Jeff. They have a lot of these different liquidity pools operating already. You can go on balancer.fi and trade all kinds of different crypto assets. And then on the other side, that's actually what I want to show in the presentation. So I'm trying to use my hands to compensate for the lack of my screen sharing today. But on the other side, we are issuing real estate tokens. These tokens are essentially STOs, security tokens, which has real estate companies that owns real estate as the underlying asset. So it's a bit meta, perhaps, but that's how we have to do it. So basically, security tokens that we issue with our clients. So you got all these real estate tokens on the other side. how do you bring those two together, all the crypto assets and all the real estate tokens? And that's where our own native brick token will be paramount, essential for all this to work. Because what we will do is we will essentially create a pool. Let's just take like a pool where we create where we add brick as one asset and Ethereum as the other. And because Balancer already has all these different pools operating like USDC and ETH, or the native BAL token and ETH, or whatever other token that there is on the Balancer protocol today. And now you have the connection between ETH and brick with the pool that we set up. And then of course we set up pools with brick and all the different real estates that we issue. So with that, you have a pure path, if you will, from, let's say, if you have USDC, the stable coin in your wallet, you can swap that to a real estate token using whatever route or smart order routing function that that Balancer has built and battle tested over the years. So that's how it will work. That's why the brick token is so essential. We're not just issuing a token and raising money for the fun of it. We're doing it because it is essential for building the functionality, and of course to build an ecosystem. Because as I mentioned in the beginning, we are trying to be an aggregator for real estate, bringing real estate on the blockchain finally. Right now, crypto investors, they don't really have, if you ask me, a serious safe haven. And that is essentially what we're trying to do with real estate on chain. So where are we now? Well, we are building the UI for our own site that will have, as I mentioned, all the different pools running underneath from Balancer and other partners. We are building all these different partnerships technically, as well as marketing wise. Technically, of course, we have a few with us today, so I'll let them talk about. So we heard from Balancer already. We got others that is here that will talk more in this webinar. And then we are building our community, people who are passionate about the real estate on chain, as we are. We actually recently passed the 10K mark on Telegram. We got 10,000 people following us on Telegram, which we were very proud of, because real estate is not always the most sexy thing to talk about, but it seems like people are showing an interest, at least, which is great. So yeah, that's where we are now. And the next step for us is obviously to launch the first version of RealEstate.Exchange, where we're working together with our partners. Yeah, we are working through all the nitty-gritty details to make this possible and safe to be able to trade real estate on chain. So yeah, we couldn't do it without our partners who are with us here today. So I think that's it for me. Unfortunately, I can't show you all the fancy stuff that I have prepared, but I hope this will do for now.
Absolutely. Thank you for that, Mark. But we still have some time left, and I see there are a couple of questions, so maybe we could just take a few of those. Okay, so Alex asked, why use an automated market maker instead of a centralized order book for real estate transactions? Do customers experience any practical advantages?
Yeah, so I think that's a super fair question. Why not partner up with a centralized exchange or create an order book ourselves? So I think fundamentally we believe in decentralization. We want to create this as a decentralized offer. We want to make it possible for anyone sitting anywhere in the world to invest in real estate in anywhere in the world. And having a centralized exchange comes with some limitations. It also comes with some opportunity. But I also think, besides, you know, the decentralized focus that we have, there are others out there who are doing that. You know, building an exchange where you can buy and sell real estate in a centralized sort of order book. So I don't think there's much innovation either to be done there. The big hurdle that we've seen, at least, is to be able to do this in a decentralized way in liquidity pools that are safe, and of course compliant.
Yeah.
You mind if I pitch in?
Yeah.
Yeah, absolutely.
Yeah, I could also say, even security stuff aside, there's plenty you can do on Balancer that does not involve security tokens, that involves building brick, ecosystem. So we have liquidity bootstrapping tools, even ones we're developing that don't require seed funds to launch a token like brick. That's not a security token, right? You can pair it with, you could take brick and pair it with a boosted pool BPT, and then it would give instant liquidity between all the stable coins and brick. And it would also earn a yield on the stable coins, right? And you could make it 80-20, that's brick and BAL for a DAO to DAO. And then you could even participate in the liquidity mining and VBAL system. So there's a whole slew of things you can do that have nothing to do with the security part. And
yeah, that's true.
If you had to, you could separate them. You could just, Balancer does all the brick stuff, and then you might have to have at least temporarily something centralized for the actual real estate. We don't know.
Yeah.
But that's yeah.
Yeah. Okay, thank you for that. Okay, so I think we are ready to move on, but Mark, I believe you'll be here for the fireside chat at the end. Yeah, so if you have any questions for Mark, yeah, just write them in the Q&A and we can take it then. Okay, thank you for that, Mark. So let's see. Next presenter is Julian Kwan from IXSwap. And Julian was born and raised in Sydney, Australia, and has founded 6 companies over his 22-year career based in Asia, including social media technology, real estate investments and development, PropTech, and blockchain. He's currently focused on building key digital infrastructure, connecting traditional finance to decentralized finance. And he's also the co-creator of InvestX, a Singapore licensed digital asset securities platform, and IXSwap, the first AMM liquidity pools for security tokens. And he'll now be talking about IXSwap's perspective on decentralized trading. So Julian, good to have you. Welcome.
Thank you. Can you hear me okay?
Yeah, absolutely.
Yeah, thank you. I appreciate the invitation from DigiShares and the team. Let me just share a screen. Might make it a bit more interesting for everybody. Calm down for a sec. Well, I'm not sure if it's so clear, but is that working, Jones? Can you see that?
Sorry, I just had to unmute myself, but yeah, we can see it.
So let me just pause this for a sec. So we've been in the space since the beginning. The first STOs were the failed ICOs, 2017-18. We'd actually set up a real estate crowdfunding platform before that, so we were licensed in Singapore. When we looked at this technology, security tokens, the use of smart contracts, blockchains to wrap real assets, it was very clear to us that this was the technology that was needed, that was actually missing in the first generation of online investment platforms, which included crowdfunding and P2P and et cetera. Because behind those websites, people were signing pieces of paper, investing in a real estate deal, waiting 10 years. Before I started that company, I was actually a real estate developer, a real estate fund manager. So I wanted to get into the space where the internet and tech would change fundraising, because there'd be zero innovation in private real estate markets since the beginning of time, except for maybe DocuSign. So then fast forward to 2017, 18, 19. If you think about the tokenization of real estate, you think about all the different assets can be tokenized. There already is tradable digital real estate. It's called a public listed REIT. Problem with that is that it is very expensive for the largest assets only. Doesn't let investors participate in the equity upside, because typically the rules are that 90% of the distributions of that asset has to go to the investor. So it's an income producing. The average public listed REIT asset, real estate investment trust in Singapore, pays about 6% per annum. and it's great. But you wouldn't even bother doing that unless you have $500 million, $600 million assets, because the cost of listing that published is too high. So let's just say this: 99% of real estate is not publicly listed because of those requirements. But there's obviously clear appetite for that. So when you think about then tokenization of all the private real estate markets, you've got to think about the key infrastructure that get us there. So what is the key infrastructure? What does every real estate fund manager need? What do the investors need? They need a token issuance platform. They need a broker dealer to raise money. They need an exchange, to trade that, they need the custody services. And, decentralization or not, the current state of issuing and trading and custody of a security requires licenses, right? So now there's lots of platforms around the world that have built security token issuance and trading and custody. DigiShares is one of those platforms that helps companies tokenize their assets. And if you then think about the last kind of pieces of the missing infrastructure, one of them is pricing and oracles, but you don't necessarily need that so much, but you definitely need liquidity, right? You need, and liquidity piece problem has been the can that's been kicked down the road for, the last couple of years. And now you're in a situation where you have, all these STO platforms out there, but there's still no traditional, there's still no sort of market making, there's no liquidity, and it's a chicken and egg problem. So what you're looking at right now, and hopefully you can see that, and I've turned the sound down, it's the first automatic market maker for creating liquidity pools for security tokens. So there's probably plenty of people here that understand Uniswap, and the innovation at Uniswap was that anyone with a cryptocurrency could turn up to Uniswap, 2 tokens in a pool, smart contracts, would facilitate the ability to trade and create pools. And then anyone else who owned those tokens could join the pools, and they could share in the market making fees. So essentially it's crowdsourced market making, it's decentralized. It's exciting, it's great. It's probably the best innovation in DeFi. And it led to basically 0 to hero trading volume on decentralized exchanges, but it was for cryptocurrency only. So if we go back to this original topic about decentralized trading of security tokens, I think it's a hybrid world right now. So what is IXSwap? IXSwap is the Uniswap for security tokens. Anyone can come to IXSwap. They can put in their security tokens. You need obviously a token on the other side. You can start the first trading pool. So just like Uniswap, but the difference is security tokens, and mainly not from just a regulatory perspective at the moment, but also from an issuer perspective. They want to know who's an owner of their company at all times. And we're still in a world where you couldn't just do this with smart contracts alone. We don't believe. People have tried that. They've been in trouble by regulators. So our architecture is a combination of smart contracts plugged into a security token broker, in this instance, Investor X in Singapore, and a security token custodian, in this instance, First Digital in Hong Kong. And we've listed the first 2 security token pools in the history of the world. So we're super excited by that. And IXSwap is built agnostic to protocols. It's built agnostic to STO brokers and custodians, because we also believe that fundamentally real estate, 99% of real estate will not be exchange traded products. And in an exchange, you typically have market makers with order books and matching engines. But if you think about it, the reason why most exchanges like, NASDAQ and, whatever it is, Singapore Stock Exchange, Australian Stock Exchange, how they operate with the top 1% of companies. Why? Because they're the biggest, they're easy to value, they're large, market makers are willing to make those markets. And the reason why 99.9% of startups aren't listed on those exchanges is because no one would make those markets. But if you think about 99% of all these security tokens in real estate, and I know I'm running through this super quick, but most of them don't belong in a traditional exchange environment, because no market maker is going to make that. If you have a house, if you have a shopping mall down the road, or somewhere in Malaysia or Singapore, wherever, and regardless of the value, it's not the type of asset that belongs in an exchange, because it just doesn't have those characteristics. But it is the type of asset that will be tokenized, and it is the type of asset that wants some form of trading. So without IXSwap, current world of security tokens, you can issue, and then you can list, right? You can list it on like an OTC type platform, anyone who's got a broker dealer, but there hasn't been any liquidity there. Why? Because traditionally OTC, over the counter trading, people would call each other with phone calls and say, I'm selling a block of shares worth X, and does anyone want to buy it? And then they'd facilitate those trades, and everything was done on paper. In a tokenized real estate world with millions of different assets, they're going to be listed as on all platforms, and hopefully IXSwap can provide that technical infrastructure for allow anyone with security token to start the first trading pools. And we call it a TradFi DeFi hybrid because we don't see currently today, and that might change over time, we don't see how the concept of completely decentralized to the letter of the law trading of security tokens is possible. Just like Bitcoin's, arguably in the cryptocurrency world, Bitcoin's the most decentralized, but still, huge amounts of the computing power is held by a very small group of people. And then every other coin, I think it's arguable that it's partially decentralized per se. So I'll stop sharing my screen right now and just sort of jump back to this. So yeah, so I think that what we're excited about is we fundamentally believe that this is the architecture that is going to be the basis for all shareholding structures. It's better to hold shares like this. If people are going to send all types of tokens around the world that aren't asset-backed, why would you not want to bring your asset-backed tokens to the table? And when they collide together, you're going to see this huge explosion of value. And in terms of tradability, you're still in a world where securities regulations exist. I think it's a world where there's no market making for security tokens, real estate or other today, because you're fundamentally in a world where there were cryptocurrency market makers for crypto. They're not licensed to market make security tokens. You're in a world where there hasn't been enough security tokens in centralized security token exchanges for market makers to bother going there. And now we're talking about a lot more exciting stuff where there's this, decentralized ways of trading, which is actually, again, in our mind, it's a combination of sort of TradFi and DeFi together, because no, quality real estate manager, you pick anyone, pick a BlackRock. If you said to them, we're going to tokenize your shares, you multi-billion, trillion-dollar asset manager, and it's completely decentralized, it's completely no one around it, there's no rules, and it's just on smart contracts, they're never going to put that out there. And whether they do that in 10 years or 5 years or never, they'd be in trouble, because the laws of security. Now, the last thing I'd say, because I'm super excited by crypto and complete decentralization and all these other things going on, I think there will be a world one day where you have, DAOs, which are, in my mind, security tokens, where there's no paper, because we're actually in a world now of tokenized securities where we're referencing shares of funds, but there's actually a fund and it's actually on paper. So the world we're in now is predominantly tokenized securities, but there is this whole new world of security tokens, which is paperless based. DAOs are probably a great example of that, where I think we can then start to make our way towards a completely decentralized trading episode, where the owners of those DAOs, shareholders of those DAOs, are happy to do it in a completely decentralized way. But that was a lot to download, and I appreciate everyone taking the time, and hopefully that makes sense for everyone. I'm happy to answer any questions.
Thank you, Justin. Very good presentation and insightful. We do have some minutes left. I see here there's a question from A. Busey asking how these platforms going to interact with traditional banks. Maybe I'm missing a step, but wouldn't there be a restriction on borrowing against mortgaged assets? Yeah, and I also know, sometimes you have something like an ISIN code for securities before banks can take it on the balance sheet. I think something in that regard. Can you maybe elaborate a bit on that?
There was probably a couple of questions rolled into one. I think a couple of things. I think, yes, there's definitely a question. Can you tokenize anything on a real estate asset if there's a bank involved and a senior lender, and do they acknowledge that? That's a big one for sure. And the answer is that's a big issue. Now, that's only one form of tokenization, right? If you're a real estate fund you tokenize shares of a real estate fund, that's completely fine, it's completely legal. That money, so if we invest in a real estate fund, we get a token share. That fund takes that dollar, it goes and buys a piece of real estate in America. It sent a dollar to America, and that's how it all kinds of works. So, but my point is that you don't need, a dollar is being sent to that real estate project just because we're holding shares as token. It hasn't affected that asset class, and therefore, in theory, the bank shouldn't care because it got its dollar, and it doesn't matter that the shareholding structure, the SPV, the special purpose vehicle, they've just got this digital share structure, because that's what it is. Tokens are a digital share versus a paper share. Everything else is still required related to buying a building, having a fund manager, and having tax. Now, the other part, I think that the question was banks. I think the really exciting part about real estate tokenization is banks, private banks, wealth managers, financial institutions, again, broad statement, predominantly wouldn't sell this to their investors. Why? Because it's not publicly traded. So if you think about a private bank or a wealth manager, most predominantly the assets they sell to their clients are publicly listed. Why? Because they're liquid, they're tradable, they're digital, etc. So what tokenization actually does for real estate, it brings, for private real estate, it brings the DNA of public market assets, tradable, digital, transferable, etc., and marries that with private market assets. And from those financial institutions' kind of business models, they're on a race to zero. Private bank, it's selling stocks. There's no money in that anymore because of all the fintech platforms. It's a race to zero on fees. They want to sell these private market assets, but traditionally, if they were paper-based assets, they wouldn't do it. Why? Because it's on paper, it's illiquid. They don't know how they're getting paid. It's a private equity deal. It's all kind of private. So there's a big opportunity with the tokenization of real estate to connect then to the whole financial market players that are only selling publicly traded liquid assets, because we're bringing that DNA to the market. Hopefully that helps.
Yeah, absolutely. That's a good question. Okay, thank you so much for that, Justin. And if you have time, feel free to hang around for the fireside chat at the end, where we'll take questions from the audience. Okay, so next speaker up is Philipp Pieper. Philipp Pieper is the co-founder of Swarm, as well as the Swarm Network, an open source project and DAO. Philipp also co-founded Proximic, which was acquired by Comscore, Loop Media, and Citadel Crypto Trading. Philipp has been engaged in decentralized technologies and crypto asset trading since 2015, and he's also a startup investor and mentor at Singularity University and StartX. He's a member of the AIMA Blockchain Committee and Digital Currency Trade Association. And now Philipp will be introducing us to Swarm Markets and talk about decentralized trading of tokenized assets. So welcome, Philipp.
Yeah, thank you, Jonas. Interesting conversations that were presented so far. So I'll try to augment that in different layers and maybe take a little bit of a different tact on some of the issues. So I've been basically in crypto since 2016. I have been in my former life actually also been part of Deutsche Bank doing private equity. I was a part of financial institution called Allianz Group, which was one of the biggest asset managers at the time, across Asia Pacific, Europe. So in some ways, when you look at today's market, a lot of things have not changed in the last 20 years. And I think when you summarize actually what, sort of DeFi and any kind of financial tooling based on blockchain can deliver, is that it will impact every single layer of the banking sphere. And I think that we all are working towards that and are now looking here at a vertical called real estate, but actually it applies across. So when we think about what we're trying to do, and I think everyone else is sort of working towards that same goal in some ways, is actually that it's about digitizing financial markets truly and not having them be part of like a vertical silo and stack. And with that, we certainly fulfill like a very key feature in bringing this Internet of Value to life. So basically sort of with self-sovereignty and decision-making, with tooling that actually every user and institution can actually control, and basically also making their best decisions of where to take it and what to do with it. So what I want to do starting off first is actually not talk about Swarm, but maybe a little bit about give a little bit of education about how sort of, digitized securities, how they work, and what some of the issues and visions are around it. Not to be too far reaching. So this is just a couple slides. So when you look at digital securities, you basically have these two very distinct layers. Okay, so one is effectively the primary market, where there is some kind of issuer that is making an investment proposal. Mostly that's, some kind of vertical, some company, some debt instrument, something that holds value, and that then basically is created as a digital version of the real thing. And there's certainly certain rules by which that can be distributed. So it's a question of actually who are the investors that are then being made a proposal. Mostly that requires a prospectus or some kind of transparency on what that offering is. And when the investors then actually have basically sort of committed to the investment and actually provided the funds and anything else that actually are necessary to actually be part of that, then based on certain investor and transfer rules, they get token allocations in this case. So digital securities that then at some point in time reside within the controlled environment, whether that's their own personal wallet or a custodian environment, doesn't really matter. But it's a controlled environment by the investors that then hold these digital assets that represent this underlying value, and it just sits there. The second layer is the secondary market. So basically now all these investors have these 100% of the tokens that represent this underlying value. So now it's about actually how can these investors transact with one another? So how can they find each other? How can they do objective price determination? How can they engage with one another? What's the settlement process look like? Where does that all take place, et cetera, et cetera? So for the longest time, actually, we all in the industry, and I'm generalizing maybe from my personal state, so everyone else, if you have a different opinion, please correct me. But I think for the longest time, we were all very much underestimating how challenging the secondary market would become. The primary market pretty much has been figured out. I think that's been going for the better part of since 2016 in different shapes and forms, different technologies being used. Dedicated chains, partially, smart contract-based primary issuance. But when it came to the secondary market, all sorts of complexity started bubbling up, and we were all from the industry looking to other players. So we started actually in the United States, and then sort of in 2017 and 18, companies like T0 and others started popping up, and we all rooted from the sidelines saying, okay, this is a great situation where sort of the secondary market will evolve. Reality is that it actually didn't really take place, not at least in the shape and form that benefits from, or that gains benefits from actually having it on a blockchain-based trading infrastructure. But let's dive into that aspect a little more. And what I've drawn here is basically sort of the current state of how a equity gets traded. And this is generally across the world, where you have effectively sort of the seller and the buyer engaging with the layer of a bank that is basically a trading bank that internally or externally are working with brokers that are then professional parties that are engaged on a professional marketplace, mostly centralized. These can be, however, slightly decentralized, not technology-wise speaking, but decentralized if it's a blackboard. And on that, the assets of the issuer, basically that represent the share registry in a public fashion or sometimes private, get actually sort of floated and exchanged. Sometimes there is a necessity in different jurisdictions to put this through a central counterparty and clearinghouse. So if you have a public stock in Europe, it resides within Euroclear. That then gets digitized through Euroclear on the stock exchanges. But effectively, what you can see is that actually going from the seller through the bank, through the broker, through the asset market, to the broker, to the bank, to the buyer, there's an incredible amount of layers that need to be checked, that need to be actually done in the right way. And the regulator needs to look at every single component in this picture to actually vet whether the compliance is actually handled well, and whether the sort of neutrality of the actor is guaranteed, and reconcile the numbers. So T0 as a name has the ambition to bring T+3, meaning 3 days of settlement, down to 0, because you can finally actually look at it as if you can, cut out a lot of the components and effectively have a system where there's a direct settlement, where the seller meets the buyer directly. They don't have to go through all these chains of different intermediaries. And basically, blockchain becomes this one layer of price discovery, engagement, settlement, and ultimately a share registry as well. And ultimately, this will be the one that is actually, met in terms of the standards of compliance. And ultimately, even further, there will be a situation which we're not quite there. We have early innings right now in Europe, but the central custodian party will also go away, because then you will have the situation that the issuers can directly issue onto the blockchain, and it will not be called a STO or a security token or digital security, whatever the name is, but it will just be a security. And it's then handled by standard terms. So Swarm in this context, actually, like mentioned, we've been around since 2016. We're basically sort of one of the early projects that handled this, issuance services, as smart contracts. It was open source technology until 2019, when we actually then discovered that the secondary liquidity issue was something bigger to be tackled, and it wasn't quite clear how that would be actually happening if we weren't going into it ourselves. After looking at, I think, 12 different jurisdictions, actually suddenly out of nowhere, Germany came along and actually amended the Banking Act. And to our surprise, as we would say, the first actually big industrial nation actually put together a very holistic view of how to handle different digital securities. And that is not just security tokens, but also utility tokens and even payment tokens, et cetera. And in the core, it meant that actually all those became financial instruments, which then conversely meant that anyone touching those financial instruments would actually need to be licensed. And we went all in, and this has been 2.5 years now. We've been actually going all in to become the first regulated entity that in this case actually is institutional ready. And meaning that because we are then institutional grade, number one, we can actually embed into other banking infrastructures. So we can cross that bridge into TradFi and embed into banking infrastructures such that you can actually have a simplistic way to embed into the known procedures that current customers are used to. But secondly, also, we are then recognized on par as a player that is actually sort of the same grade and quality that other banking institutions have. And still, we built it what we call with web native or Web3 native market infrastructure. And I'll talk about what that means. The ultimate goal here is, I think that a lot of people here are striving towards that, is that we create a system that allows, number one, a creation of very, very different assets than those that exist today. Let's be honest, a lot of the utility tokens that are out there that basically are trying to display themselves as something that is not a security, but in the end, actually, there's economic value flowing through it. And there has to be a realization that it could be much easier if actually those were really called also security tokens. But more than that, I think that we are entering a phase, and we've seen actually the current events with Tornado Cash last week, and sort of the whole discussions around the MiCA regulation in Europe, where the question is basically where's the regulatory acceptance of our space, our blockchain-based trading going. And we believe that that basically by preserving Web3 and DeFi principles, that we can create a situation where still regulators can become comfortable around it, and you don't have to go down the path of actually going to hosted wallets, which in my mind actually would be sort of not relevant, building a system that really exploits the blockchain to the truest extent. So what we did was, in this context now, because we've been now provisionally licensed for a while, we actually built the first inning of a platform that so far shows the following. It's effectively in compliance with German or European regulations. We and much to Jeff's actually credit, we built at the start actually on top of Balancer V1. But we built around it basically a system that allows us to do certain access control. So we actually can control the participants, we can control the assets, but we also can control the methods. So in this case, it was Balancer V1 AMM method, but it was just a first thing, right? And by doing it that way, we could actually still preserve all the key principles that DeFi actually have, meaning sort of self-custody, the transparency aspects, composability. And these all, and I credit the question earlier about like why AMM, well, that's not a self-purpose. The purpose here is that if you actually can create these entry points into the digital realm and you still preserve the composability, you suddenly become more than just you scripting the entire stack of financial products. So if you think in terms of tokenized real estate, well, every real estate can become its own token structure. And then you can suddenly create meta structures very easily where you have different categories of real estate actually clustered together that then become their own index of some kind. So there's a real purpose to actually having something reside on a sort of a decentralized composable infrastructure, and not to limit that to one platform or one issuer and one vertical stack that puts it all together. So we started off with AMM technology. We built decentralized OTC markets. We're obviously sort of going into other directions behind the scenes, but we're very careful, and I would call it a little, diligent, actually, how we put this in front of the regulator, because already it's been pretty much, mind stretching for the regulator to actually accept that there's a non-order booked based trading system. One of the key challenges there, as you can imagine, is basically that suddenly it changes the way that you think about counterparties, meaning who is the counterparty when you trade against the pool? Of course, you could claim it's the entire pool, or is it, right? We could all find answers to those questions, but they need to be sort of incompatible with the way that regulators think about this. So far, we are on EVM compatibility, but we could take this almost anywhere that we decide actually that it brings use to our customers. I want to remind you of actually that earlier picture about the primary issuance and the secondary liquidity. So far, we've been doing this as a core platform. We are going to release very shortly, actually, sort of what we call market as a service product, which is effectively just a segmentation of different parts of the system encapsulated in a sort of entire embeddable solution that then actually every issuer can actually embed into their own environment. They can control the parameters of actually sort of what it is that they accept, who are basically the investors that they want to accept here, and control that whole process from a behind the scenes administration layer. And just to complete that, digital issuance actually means more than that. So just the simplification of the trading landscape still requires you to do all sorts of different things that on the issuance side that actually preserve the trust with the consumer that is ultimately, or the investor that is ultimately going to invest into it. So we've built an entire suite of functionality that is actually embedded into Gnosis Safe as a multi-signature environment. It's basically a ready-to-go application that allows for private and public offerings. There's different rule sets that can be put in place on the trading and investor side. It can be embedded into secondary liquidity platforms, not just our own, but others as well. It has special on-chain documentation of redemption flows that go into that, which is a key thing to actually, make as little as possible actually happen behind the scenes, but in front of people's eyes. And then just, generally speaking, trust features, which means sort of, how do I make disclosures, and how are the token entities actually connected with those disclosures? How do I have a full chain of visibility into the history of disclosures? How do I do different distributed roles of actions here? So what is the issuer? What is the sort of administrator? And maybe to tie in auditors, et cetera. And then we've also come up with different methods of actually do safeguarding. So what if there's a question about the trust of some token structure? Is there a way that the owners of the tokens could take action in some ways? Briefly to close this off, so where's this all going? We have introduced the first sort of stacks of liquid staking that are what we call sort of institutional grade. This is not meant to actually replace anything that is out there in terms of Lido and other staking providers. But as you can imagine, there's different investor realms that have a different grade of expectation of how to actually run and operate the full stack. and more importantly, actually, that are not capable and willing to risk being in environments that are not really qualified as licensed. And obviously, then there's a trading benefit that if you have all different liquid token methods actually on one chain, you can make all sorts of indexable products, etc. Our ambition, we're not quite there yet, but our ambition is actually to go full to all public securities, which means that we're not going to have, synthetic products, but these are going to be fully asset-backed products that are tying into the TradFi markets. And again, because we are what we are, we can layer on top of the existing structures. And then this market as a service has some exciting, verticals that are currently actually in pilot. Real estate being one of them, and we can actually have a whole session actually dedicated on that and what we see there, but that would just eat up time. There's carbon certificate market trading. There's different music-related methods that are being sort of put in place, and then sports are very much also, or fan-based assets are very exciting, just because there's a huge amount of users that are connected to that. So with that, I'll just pass it back, but if there's any questions, happy to answer them.
Great, thank you, Philipp. I think we're fits with the time, so yeah, I just think we're going to go to the next presenter, but thank you so much once again, and I hope to see you in a bit at the Fireside Chat. Okay, so yeah, next presenter is Niklas Reichert, Sales Director at Fireblocks. And Fireblocks is the first digital, or the #1 digital asset infrastructure provider in the market with more than 1,300 customers globally, including BNY Mellon, ANC, and Checkout.com. At Fireblocks, Niklas has supported leading institutions to build, run, and scale profitable digital asset businesses by helping them find efficiencies in their crypto trading operations, supporting innovative tokenization strategies, and facilitating access to key counterparties within the digital asset industry. And now Niklas will present us to Fireblocks and decentralized trading of tokenized assets. So yeah, Niklas, welcome.
Thank you, Jonas. I hope you can all hear me well. And thanks again for the invitation, Jonas and Klaus as well, and DigiShares. It's a pleasure to be here. Let me first of all share my screen so I can also prepare the little presentation. And please just confirm if you can see this for today.
Yeah, we can.
Great. So before I start, talking about decentralized trading of tokenized assets, and I think we have had some great presentations already from my co-presenters today. I want to use the time to introduce Fireblocks shortly to those who know it and those who don't know it as of today. And then I want to talk about, different challenges that we see when it comes to engaging with Web3 in general, and not only decentralized trading of tokenized assets, because I think, in the end of the day, we have the same challenges, whether, we want to interact with whatever type of decentralized app. And then hopefully, if you have some questions, some time for that later as well. So to just give you a quick overview, Fireblocks is now a 4-year-old company. As Jonas said, we are a digital asset infrastructure provider. We have been founded by 3 gentlemen, Michael, Idan, and Pavel. We have raised since inception more than $1 billion in funding from investors like Sequoia, Stripes, DRW, D1 Capital Partners, and several others. We have now reached 550 employees globally. We actually gained a little more customers since recently. So now we serve more than 1,400 institutions, including, also recently announced BNP Paribas, SDX, Checkout.com, ANZ, and several others. So our philosophy is really, that we provide infrastructure for you to do self-custody of any type of digital assets, whether it's a cryptocurrency, a tokenized assets, an NFT, a stablecoin, whatever it is. We just provide you with the infrastructure to self-custody those assets securely. So we are not a custodian, but a lot of the regulated custodians actually use our technology to keep your assets safe. We're headquartered in New York, R&D in Tel Aviv, and sales globally. So as of today, Fireblocks by the numbers represents more than 3 trillion worth of digital assets securely transferred. We have created, or our customers have created, more than 50 million wallets, and depending on the value of the cryptocurrencies to date, there are more than 50 billion worth of dollars stored on Fireblocks technology. We support 41 protocols, more than 1,400 tokens, and we are the only infrastructure provider or technology provider that has ISO certifications for privacy, cloud, security, and also we are SOC 2 Type 2 compliant. So we really try to bring, institutional grade infrastructure to any type of institution. So what do we see actually with challenges with tokenization? So I don't want to spend time on all those 4 points here, but we believe, on the one hand, you need secure infrastructure, obviously, to protect yourself against both internal and external threats. You need developer tools that provide you with robust APIs and SDKs, enabling, for you to have automatization and faster time to market. You need to also have an infrastructure that is scalable. So for you, to hopefully, with more and more demand in the market and more adoption, you obviously also need an infrastructure that scales along with your business. And the 4th pillar, what we see, and we've seen presentations by my previous colleagues so far, you need to have a secure connectivity into the Web3 ecosystem. Because, whether you, and bringing that back to real estate tokenization or the decentralized trading of tokenized assets, you need to bring your wallet into the Web3, whether it's, whether you're a buyer, whether you're a seller, whether you're the custodian, you need to have a secure wallet infrastructure, and you need to securely access the decentralized Web3 world. So this is why I want to focus on that today. Of course, Fireblocks can help you, with all 4 pillars, but I want to put special emphasis on the access today. So Fireblocks recently, or in the beginning of the year, launched its very first Web3 engine. And I focus specifically on our DeFi suite. So the DeFi suite really allows you, whether you're the issuer, whether you're the custodian, whether you're the seller or the buyer, to build services for yourself, for your business, or for your customers to securely interact with Web3. So what does that actually mean? So you can connect, to all the top EVM and non-EVM DeFi chains, whether it's non-EVM like Algorand and Solana, or whether it's Polygon, Ethereum, and so on. Secondly, we are the only solution with policy control on DeFi. What does policy control on DeFi means? So you can create policies to secure DeFi transaction, including customizable limits by smart contract to limit risk. What does that actually mean? So if you would want to interact or connect your wallet to any decentralized app, and your operations team would like to create a transfer of 100 million plus, you obviously want to limit that and include 4 to 6 or 8 I principles before this transaction is actually approved and then signed onto the blockchain. On top of that, we have the ability to whitelist and address as a contract. And as you can see here, I also put Curve as an example with the recent incident that we saw just in the last weeks, that if you whitelist the smart contract of the decentralized app that you want to interact with, even if that gets changed, if you get redirected, to a different smart contract that looks like Curve in that sense, you wouldn't be able to interact with it, and you wouldn't be able to send funds to the wrong smart contract address. So obviously it offers another layer of security for you there. And third point that our DeFi suite actually offers to customers is that you can launch, trading capabilities for your users or for yourself, by enabling the simple and secure access via the Fireblocks DeFi gateway. What are actually the 3 DeFi gateways that Fireblocks has or enables? So we have our own integration with Wallet Connect that allows you to, any decentralized app that supports Wallet Connect to either use the desktop version or the QR code scan this QR code to connect your wallet. We have our own fork of MetaMask that allows you to use the browser extension that we provide in a secure manner. And we also have our DeFi SDK that allows you to programmatically interact with decentralized apps, smart contracts, and make contract calls on a programmatic basis. So what is the difference here actually to using, standard wallets that you made or that we are all familiar with? So Fireblocks uses, its own MPC CMP algorithm. It's a multi-party computation algorithm that has been derived from the original GG18 algorithm by our cryptographic team. It's open source, it's peer-reviewed, and it allows you to have a multi-layer security approach where we have 3 key shares that reside, on different tier 1 Intel SGX enabled cloud providers and are never getting together to one piece to actually sign a transaction, create a wallet, whatever interaction you're going to do with the blockchain. So it means even if you use our own fork of MetaMask or a Wallet Connect, your private key will not just be encrypted and stored then in the browser, it will still be protected in the same way as if you would interact with the centralized entity as with the decentralized entity. So I think, this is just what I wanted to emphasize today, that, how do you actually interact with decentralized apps or decentralized applications for trading purposes of tokenized assets? It's very important. And I think it's going to be one of the key elements for you or for the industry to also succeed going forward. Because if we can't interact securely, then I don't think we see the adoption that we want to see. That's it for me today. If you have any questions, please pop them now. I think I've just reached my 10 minutes. And if there's any questions, please go ahead.
Yeah, thank you, Niklas. Very good. I see there's already a question here from Brandon asking if Fireblocks store and manage the PVT keys.
PVT key. Let me just read the question myself. Sorry. Here we go. Private keys. Yes. So we don't store the private keys, right? So we are a infrastructure provider. So we use MPC, as I said. There's not one private key ever existing in our platform. We have 3 key shares that we collect partial signatures of, that are then combined in the broker service to one full signature and then broadcasted to the blockchain, which means that 2 key shares are hosted on Fireblocks environment on our customer's behalf, and the 3rd key share is hosted on our customer side. Since it's a 3 out of 3 algorithm, Fireblocks has never the possibility to move or access your funds ever without you. And also what Fireblocks provide you is a disaster recovery mechanism that you even can recreate the private key in a hard recovery without Fireblocks even to be in place. Maybe we have, cease to exist. So you always have full control and access to your assets. I hope that answers the question.
Great. I think it does. Thank you so much for that. And I think we are out of time now, but I'll see you in a bit at the Fireside Chat. Thank you so much.
Definitely.
Niklas.
Thank you.
Okay, so next presenter and today's last presenter is Derek Boirun. I hope that pronounced that correctly. And he's the CEO of Realio Fund. And Derek is an entrepreneur with institutional experience in commercial real estate development, EB5 capital investments, and blockchain-based investing. He previously founded and currently acts as a managing member of American Economic Growth Fund, an EB5 investment platform focused on sourcing overseas capital for US-based real estate projects, which to date owns 2 regional centers, hosts over 100 investors, and sponsors over $1.2 billion in total project cost. Derek was previously involved with the development of major urban real estate projects while working at Chismans Bayer, a leading owner, developer, operator, and fund manager of first-class real estate worldwide, with a property portfolio in the excess of $70 billion in total value in the United States, Europe, Latin America, India, and China. And now, luckily, we have Derek here with us today, who will present us to Realio's perspective on decentralized trading. Welcome, Derek.
Great, thank you. Can you guys see my screen?
Yeah.
Perfect. So yeah, a quick overview on us, on Realio, and thank you for the introduction. Being last, I think this presentation is going to be pretty high level and more summing up a lot of what everyone has said. We're building a lot at Realio. For the sake of this webinar, I'll stay focused on the digital security side of our business. I founded Realio in 2018, a few years after leaving my career. I was working for a large institutional real estate developer here in NYC. I'm also a graduate of Columbia University's real estate development program. So, the NYC development scene has been my home for some time. At the time of founding this company, we really wanted to start a fully blockchain native real estate fund. However, we were much too early to the market. So we decided, let's put our heads down and start building the tech for it in anticipation. I think many have admitted that we all underestimated the effort that would be involved here. A lot of issuers think they're going to spend a couple $100,000 and a couple months and build a platform. They end up spending 3 or 4 years and $5 million, right? So, we saw that early on. We started building, and at our company, we're believers in decentralized technology here, like everyone else on this call. So, everyone else or everything that we do, very blockchain forward as compared to the greater market for digital securities. We even tokenized 100% of our equity in the technology company under the ticker RST, which will trade on T0 soon. And we'll also allow holders to run validators on our network very soon once it's launched. So an industry first for a digital equity. When discussing decentralized trading in the context of central digital securities, it's important to differentiate crypto asset from digital security, right? So they're not the same. Crypto ideally is fully decentralized and permissionless, no person or company in control of it. Access to it only requires a computer and internet access. Digital securities, on the other hand, are traditional securities. They're only represented as a digital entry on a blockchain. In an ideal world, digital securities maintain all of the peer-to-peer functionality of pure crypto assets while providing holders legal ownership of the underlying security. Potential benefits, what does blockchain have the potential to add to traditional securities? 24/7 markets, ease of fractionalization, peer-to-peer trading, efficiency and scalability, lower fees, fewer middlemen, and as many have presented, access to decentralized finance to leverage your assets, which is one of the more exciting aspects of what this technology stack can provide. Why has tokenization of securities and real-world assets not become mainstream with so many benefits with the technology? Because regulation is at odds with the market. In other words, securities regulation has not found any product market fit in today's technological age. While many tokenization platforms have sprung up, STO and secondary market volumes are extremely low. Barriers to entry for issuers and investors are extremely high. Level of effort to get a compliant offering takes months. Accreditation rules generally eliminate large majority of the potential market right off the bat. Compliance costs alone are too much for the average issuer. Generally speaking, the crypto industry that works outside of securities regulation is thriving, mainly because the product market fit in terms of retail access and limited amount of trust and third parties involved, right? What I'm witnessing is users or potential investors prefer crypto without any underlying rights to equity, to underlying assets, to doing accreditation, doing KYC, and going through all of the legal barriers involved in getting into securities, which is our main challenge still. This seems counterintuitive for us to issue securities because we believe we're offering things of real value to investors as opposed to the scams or other things that exist in the crypto world. Crypto has no underlying rights to anything, and it's created out of thin air. So why does the market prefer it? But the market doesn't agree with us as issuers of real world assets yet. We think it will. But we have some things to overcome. I think it's regulation that we really have to address, and that's going to be a long fight. So how can we disrupt an industry that's built around 100-year-old rules, right? In my view, we need to stop trying to recreate it. Use blockchain for what it's worth and work in our best abilities to push boundaries while staying within the intent of regulation and investor protection. We can't comply with rules that are not written yet, but we do know why they're written, so we can be good stewards of this market as we push it forward. If your product requires trust, you have to be trustworthy as an issuer. So it doesn't matter how decentralized your product is if the trust side of it is broken as well. We need clear exemptions and regulations designed around the peer-to-peer markets for this industry to thrive. Without it, regulators are leaving us to use our imagination. And I think a large majority of the institutional world doesn't like to do that. So where do we go from here? In my view, we will see securities begin to become more bear-like in nature, taking on more crypto qualities. That might be a controversial view, but I think it's necessary. Many stakeholders that currently exist in the securities transaction sequence will be consolidated. This is already happening as many digital securities platforms are taking on many roles internally, especially those required by regulation. Issuance of securities will become more seamless for the average user. Blockchains will completely replace the need for the transfer agent, which in my opinion is becoming irrelevant. And real assets will find a place in decentralized finance. With all of that said, something I'm excited about rolling out very soon is our issuance stack for digital securities. Very much in the same vein as Swarm and some of the others. We've spent the past few years designing this around our own issuances. So we think issuers will have similar goals, or issuers who have similar goals will find these tools exciting for managing their own deals. Mainly our stack will include full issuer control of issuance and compliance, easy creation of whitelisted liquidity pools for compliant assets, full real-time cap table management and holdings, tracking peer-to-peer trades, LP positions, which is a bear in real time across various liquidity pools and various chains and other staking activities. So with that, I'll hand it back over.
Thank you for that, Derek. Yeah, I don't know if any of you have any questions for Derek. If not, maybe we should get to the fireside chat. So yeah, if all of the presenters, if you could join the stage. And then to the audience, if you have any questions for the speakers, write them in the Q&A now, and we will get to them, hopefully. Okay. Yeah, let's see. We already have some questions that you sent to us beforehand. So let's just start by looking into some of those. Yeah, so first and foremost, I think it would be good to have some more clarity, or actually you already touched upon that, but how do you guarantee market liquidity? Do you have any measures in place to guarantee that or bootstrap that? I know Balancer has some, but yeah, I think it would be good if you could touch a bit on that. Maybe Jeffrey, if you could start.
Okay. Yeah, I mean, we're all about liquidity provision. There's, I think, I'm not sure what the current thing is now, but there has been over $2 billion like on the platform. It drives in various value. So, so we really leverage composability for things like liquidity. So, for instance, we have the boosted pools that I referred to. You could make a pool that is paired with a boosted pool, and a boosted pool it's like having 6 pools in one. So we have a BBA USD pool that's USDC and DAI and Tether, and also the AVA wrapped versions of all those tokens. So there's 6 tokens. So you can trade between, you can make a pool, compose that, and trade between your token and any of those 6 tokens immediately. And you have access to the full liquidity of that. And then you can build, you can also pair, you can make other composed pools with other kinds of stable coins and then pair with that. You can also make, things like indexes with large numbers of tokens that all can trade with each other. And also we have the order router. So you don't have to trade only within the pool. You can trade across multiple pools. And the way we have that, especially with, as one big swap, you can actually, and you can even join and exit and swap in one transaction across multiple pools. So that's very powerful for, liquidity.
Yeah. And you also have these bootstrapping pools, don't you?
Yeah, for starting it, yes, we have the bootstrap pool, and that's where, you start with a high balance of your token that you want to sell, and then a low a capitally efficient, low value of a token you're selling for, like usually a stable coin, and then as you sell it, the weights follow the balance down, so the price remains basically constant. So you can do over 3 or 4 days. There's no incentive for bots to buy it in the beginning. It's very distributed, and we're actually working on a version that doesn't even need that. It doesn't need any seed capital at all. It uses our asset manager functionality, so you can start with no capital and launch a token.
That's great. Looking forward to that.
I mean, we've done over 300. That was my first project. My first project in Balancer V1 was the V1 version of the liquidity bootstrapping pool. We have one now, and we have other partners that have taken and wrapped it. There's Copper Launch that does that's a partner that does launches now. They've wrapped our pool, and then we're working on, and we've done, I think 300, or we and they have done 300 some sales. I think 2.5 billion volume, something like that. It's been very successful.
Yeah. Okay. Thank you for that. And what about Swarm, Realio, or Fireblocks? Do you have any tools or services that can complement this or help create a liquid market?
So let's actually first of all acknowledge that there's obviously sort of a more complicated question around actually compatibility and counterparty risk if you look at liquidity. So the wider pool of today's DeFi crypto trading may actually not be compatible with certain actors that would want to actually provide liquidity. So if you're from the institutional space, there's some that take the position that they can actually do a risk-based approach that basically say, okay, we're going to do our transaction-based assessment ourselves. Others, because of compliance, they cannot engage. So to us, it's been always like the goal to actually serve both aspects, where we want to bring more liquidity that so far has not been part of the current ecosystem by providing these connectors to these traditional or maybe more adventurous institutions into the space. And if you go into certain verticals, it actually is more stringent. So if you look at a vertical like real estate, one of the key benefits from digitization in this case, so Germany, for example, has transaction costs for real estate of 10.5% or something to that tune, right? So if you can digitize and you don't have to, incur the full stack of transactions, maybe that goes down to 3%, 5%, but still that's an significant economic uptick, right? So by actually putting even the smallest of real estate into an ecosystem like that, the professional trading organizations and the brokerages have a benefit from actually engaging in the digital version of it. And so and they can actually provide the markets themselves. So the whole concept of actually the asset holder being the liquidity provider, it's a feature. It's not a drawback. It's actually something that the entire category can benefit from, and are starting to realize that. So it's less about connecting, for us, it's less about connecting sort of the wider liquidity of DeFi and cryptocurrency with real estate, but rather to provide tools that exist and benefit the entire category of real estate and make it composable, and even the smallest ones make a price discovery that works and doesn't have too much slippage. So that's where you need to go for OTC rather than for pool-based transactions that are incredibly better in terms of like price discovery than if you look for Blackboard-based systems that are, unfortunately, the US and all ATSs in the US are basically still Blackboard systems that are anything but real market-based pricing. It's basically anecdotal price discovery. So I think that already bringing this kind of version to that space is already going to provide incredibly increased amounts of benefits.
Yeah, absolutely.
I would say just on that point, it's not a tools problem. Right now, it's a liquidity problem. We've all the tools for building pools, the tools for creating liquidity are there. We know how to whitelist them. We know how to make them in a compliant way, but we need participants to come in, right? You're either going to find a ton of organic market liquidity, like you found on Uniswap, and there are professional firms that actually provide large amounts of liquidity there. You just don't know who they are. They're all pooled together. Or we need to get big market makers involved in the digital security space. And I think that's going to happen. We actually need both of those things to happen, but it's a chicken and egg problem, right? Because liquidity providers are there to make a profit. And they take risk with impermanent loss if you're talking about automated market makers. So we need volume. They get fees off of volume. So, I think the liquidity argument, which one's going to come first? It's going to have to be the liquidity. So, as an industry, we're going to have to start providing it, right? We need the organic side of it to come in. We need the volume to come in, and then we need the big players to start, participating as well. And that's how, that's how the liquidity market can become more robust than it is right now.
Yeah, maybe, sorry, I wanted to add something there as well. I do think, the biggest challenge that we see, and I think Philipp mentioned it also before, we have Germany as a very strong industrial nation to come quite forward, especially BaFin, with some regulatory aspects that allows highly regulated institutions, to participate in something like crypto or digital assets, Web3, whereas, there are a lot of the nations are still very much behind to even allow, the institutions that could provide, large amounts of liquidity into the market to even interact with it. And I think one very interesting project that we saw recently was from, the Monetary Authority of Singapore, MAS, that launched Project Guardian, that is actually suggesting that you have a KYC or permissioned DeFi pool for regulated institutions to participate in there. So, because, that's the problem that we still have with DeFi or the regular DeFi pools, that you don't really know who you participate or who participates, and that you just for regulatory purposes cannot interact with it because you can't prove, where the money is coming from, who you're financing. So I think, that's also what Swarm obviously followed to be fully regulated on that side to enable large institutions to participate. And until we have clear regulatory insights or guidelines, I think, we're not going to see the mainstream adoption that we want.
Yeah, and I would add as well, something that is evolving in a large way is mortgages that are backed by Bitcoin, right? Most of these services and these platforms that provide this are centralized, right? You're basically giving your Bitcoin to them to hold until you repay the debt. But there is potential to take advantage of existing liquidity that exists in the DeFi space, mostly on Ethereum, because that's where the most liquidity is, but it's evolving into other chains. But if we start to look at our ability to borrow against or to borrow against digital assets to purchase real world assets, now we're merging existing liquidity to get and acquire real world assets. And if we can get these real world assets now on chain and mix the pools, we have a big advantage with the existing DeFi landscape in that regard. That's actually something that we're working on at Realio as an attempt to provide a DeFi alternative for mortgages for homes. But we'll have more on that in the coming months.
Yeah, sounds interesting. Absolutely. And I think what you said before about liquidity providers, sort of the chicken or the egg problem that you have right now, Alex has a nice question that ties into this, asking if you're not incentivized to be a market maker, why would they be incentivized to be a liquidity provider? Is there anything you can do to attract liquidity providers, or do you simply have to wait for institutional players to provide the liquidity? Or how would that happen?
So I'll comment on that. I think you have to think of different markets and assets in a progression, right? So if you have a certain real estate asset that actually doesn't have a public market because it's just been freshly sort of put into the semi-public market, either as an STO or as a public security, well, it is in the interest of the owners of that security to actually make their own market. And it might actually justify to have extremely high fees that someone transacting there has to pay to the liquidity provider until the market becomes more liquid. So because it's a lower frequency of tradability, there might be excessively high transaction fees that justify, or they're subsidized by some other means by the asset holder, the issuer, that then incentivizes us in a different way. Now, while the market progresses, it becomes more liquid. Obviously, then the fees, the swap fees, and the pools can actually go down, because then it becomes easier to attract capital. So there's not the one or the other kind of response to this. I think what we are experiencing right now is that that a lot of the issuers are suddenly starting to understand that they, as issuers, can actually put sort of their assets into this context, and they will actually start to generate yield. What that yield looks like and how big that is really dependent on how they create their market. So it's almost in the hands of them marketing their own market in their context, which often they're doing today anyway, right? So if you have someone promoting their real estate fund, or they have their own real estate that is being brokered, it is no other activity than generating sort of traction for their assets in investor landscapes that then come in. So there is no longer the necessity to think about the market maker and the liquidity provider in a separate function. And I think that is the beauty of actually the AMM model that Jeff and others have helped promote, to make that as simple as it can, and you don't have that bifurcation of professional firms that need to understand the order sizes and so forth. But there's a much easier way to understand what's going on and actually participate in that market.
Yeah, absolutely. Good insights. And I also just want to throw the ball to Mark, just to envelop him also with RealEstate.Exchange. What your view is on liquidity, and what exactly you plan on doing in that regard.
I think it's a bit difficult to add more. There's a lot of brain power in this room. And a lot of good things have been said, but I think what resonated with me the most is that liquidity is king here. We got the tools, we know how to do this now. Liquidity is now what is needed. And for that, we need institutions, we need, safe protocols. What I would like, sort of a shout out to the industry, is to put more focus on, auditing, making your protocol secure, because the more we see all these hacks happening left and right, it seems these days, the more hesitant we will see both users and institutions coming in. Balancer, just to throw a little nugget to Jeff and his team, Balancer has historically been extremely good at safeguarding and putting security first on their protocol. I don't know if you guys are still number one on DeFi safety, but you used to be, at least, Jeff.
Yeah, we
had also one of the
first one to
reasons
get 100% rating.
Yeah, exactly. Which is also one of the focuses that we had, because we know our customers, they will have that as the top priority for them. And then second is liquidity.
And I'll also add that, on the utility token side, you can also, the liquidity of the security tokens is a separate problem, but when you have something like RealEstate.Exchange where you have the brick token, that's a utility, then, you have all the capabilities, all the functionality available on Balancer to build, make pools with brick, pair them with yield generating tokens, participate in liquidity mining. You have ways to grow your brick stack, organically, which then can be put over the fence, on the other side. So that's one aspect where you don't need to worry about securities if you just on the utility token side.
Yeah,
plenty of
that's a good
liquidity on
point.
that.
Okay, so I'm just gonna see what else. What other questions there are? There's one here asking what regulatory changes are required to allow for further adoption of digital assets and more specifically security tokens by traditional finance. And I know Philipp and Derek, I think you already briefly touched upon that, but I think if you just briefly could summarize your position, your view.
Yeah, okay, so I think we have come a long way. And I think the last 2 years, there's been a lot of rails being put in place in different jurisdictions. Obviously, we favor, the German one, and we have questions around others that are not really there yet. It's about going through the process and actually sort of educating the regulator along the way what that means. And that's what I was referring to in this presentation is of it, we've been putting some, in their minds, mind-bending concepts in front of them and saying, okay, so, but it's worthwhile to push that through and have them accept this new reality that, for example, there is no control over an order book or anything, right? Or that self-custody means something and it's a purpose, right? Or that the embedding of other tools like Fireblocks or other wallet infrastructure matters and is different than actually the trading venue. So there's a lot of things that, obviously, I think we're now in a position that we can do things. Now it's about taking off the training wheels and actually getting that out there and proving that the market can actually work with these tools, right? And this is luckily in Germany a little different than, for example, in England with the FCA that is still working with sandboxes. We are now capable to actually do this in real time with real market participants with real capital and are not necessarily having, we still have to prove on a daily basis that we're worthwhile to operate this way. But it is an early market, but I think a lot of the impediments have been sort of put out of the way. So we were lucky that we're invited to actually help the German finance minister think through some of this. And my standard sentence to him is actually don't fuck it up. Because right now regulators can get in their own way. And right now, actually, if you look at the national regulators and European regulators and then the OFAC and other coordinated efforts actually coming together, there's a lot of good reason to believe that still red tape can prevent good things from happening. But I think there's enough people recognizing the goodness and what it is and where it can lead to that are willing to take it as a trial to actually see the first explorations and go that next step. But I think we're there. I think the next 12 to 24 months are going to be extremely exciting because, let's be honest, for the next 6 years, it was the year of the STO and it never happened. I think this is very, very different today.
I agree with all of that. I think in the US, there's, getting or redefining accreditation rules is an absolute must. That should have been done years ago. But having money doesn't make you smarter with your money. Just having more of it. That means nothing. And so much of the market is just eliminated from interacting with securities because of this. It doesn't make any sense that use the test, whatever it is. There's a lot of proposals that are better. But if retail, is now with an opt-out or some sort of test able to participate in a Reg D 506C offering, we've immediately, that's a great offering, right? And the market can develop around it. Lockup periods, they can be good for the issuer because, I think the market gets a little bit too antsy sometimes before they don't have any patience. So sometimes lockup periods can actually benefit the issuer and the investor from themselves, right? If we protect them from themselves. So, I don't know if that really needs to be defined, but we got to eliminate accreditation rules. That's an absolute must.
And Derek, just to highlight what you said earlier, 100% agree with actually the transfer agents no longer having a role. And then we have to talk about actually then central custodians possibly also going away. That is, unfortunately, America is going to be taking a long time before that happens, but that is absolutely a must, because otherwise you're creating like, paper-based processes as the foundation for a blockchain to operate. And, it's like square peg round hole kind of situation, right?
Yeah, it's redundant and unnecessary.
Yeah.
That's what tech is for. We make things faster, cheaper, better with technology, and that's always the winning path. That's the natural progression. We just need regulation to catch up.
Yeah,
absolutely. Good points.
Yeah, and maybe also what I want to add on that, I think Derek and Philipp made really good points. And when we see now regulation allowing those institutions to dip their toes and test it out, I think then it's also down to us, to continue educate and make them feel comfortable, because obviously it's all new waters for them. I mean, we all had conversation with large traditional financial institutions where, there's still a lot of education needed, a lot of comforting, and make sure that they achieve and whatever they want to put to the market is also going to be successful. Because if that's not going to be successful, maybe others will stop trying. So we need to have successful projects when it's not allowed. We need to make sure that those are going to be successful.
Agreed.
Fully agree. Thank you for that. Okay, so I think we're just going to take one last question, and I think it would be good if we could hear all of your views, just briefly summarized. So we have a question here saying the World Economic Forum states that the 1800 trillion market is open to blockchain. How do you see tokenization market evolve? What are the limitations and what are the key barriers to mainstream adoption? And we already touched upon that, but starting with Mark, I think it would be good if we just could get like a quick summary on what you foresee in terms of tokenization.
Well, I think I'm known for saying that this year was supposed to be the security token year. And someone said on the call that never happened. So I'm still betting on that, to be honest. Securities will have its day in crypto, and I'm sticking to it. That's what I think we will see more of. I think we all agree on this call that all kinds of assets will be not just recorded, but also traded and transferred on chain. Securities will be a huge step in that direction. So that's what I see coming big time.
Agreed. And what about you, Jeffrey? How do you expect the digital asset market to evolve in the coming 20 years or so?
20 years.
That's a long time, yeah. Big question.
That's like centuries in crypto. It's hard. Yeah, it's hard to even look ahead a year. Yeah, mass adoption is tough. I mean, and even especially with securities. I mean, really, even what percent of the general public even owns securities normally, right? It's actually not that many. So, and then the percentage of crypto penetration, even though it seems to us like everyone's doing it, it's not really, right? Compared to the full population of the earth, very, very few people are in it. So that you've got two kind of low probability things. So, a lot of it's, I think, in addition to the regulation stuff, it's just the trust in it, I guess, because for it to be mass adopted, it has to be easy. So there has to have to be, UIs they're decentralized underneath, but they look like the familiar centralized things that people are used to dealing with. It looks like a bank. And a lot of the apps like Robinhood, is going in that direction where it's a friendly app that looks like everything else, but it's actually tied to, finances. So I think the usability is one important aspect, and then just the trust in it. And that's maybe the biggest thing is that people have to trust it. You have the media and you have all these crashes and scams, and at some point you have to separate the wheat from the chaff there, and people need to trust in what they're doing.
Yeah,
I think Balancer is kind of at the forefront of that, and your reputation, having a strong reputation for safety and ethics, which is lacking in central. When they realize it's actually easier to trust a
Yeah.
well-founded protocol than it is humans. And we've just seen this in the recent, CeFi versus DeFi. You actually can, it removes the human element. So you actually don't have to trust people, but that's a big education effort. And people aren't, the general public isn't anywhere near that yet, I'm afraid.
No. Hopefully at some point. Okay, thank you. And Philipp, do you want to give your view on things?
Yeah, so I think so. First of all, it's worth fighting for this because obviously when you look at bond and equities, they're 100 trillion, and then you have sort of derivatives that are 700 trillion. This is like orders of magnitude bigger in terms of a honeypot than actually the current crypto market is. So if we get it right, there's a big payoff, right? But I'll put the two main aspects actually sort of front and center. So first of all, I think let's talk about value add. So first of all, we all talk about like what the digital securities have in terms of value add, and we want to believe that it's cheaper to engage, it's faster to execute, the price discovery will be better, yada, 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 transparency is there. Well, we have to prove that, which means that and I think Derek was referring to this, like we have to prove on a case-by-case basis that actually this holds true, this claim, right? And that's not necessarily always the case because regulatory is a bitch and it's really hard to execute on. The discovery process organizationally about dealing with technology is challenging, and Fireblocks can speak to that probably because engaging different roles in this new way of interacting is really hard. But even if you get that all right, we've so far only spoken about basically this. I can always compare it to when the web started. New York Times being distributed by PDF was already a benefit. But it's not what really made everyone engage. It was that suddenly content was done differently, right? So New York Times today looks very differently than that PDF that I was sort of referring to. And I think we're going to find the same thing happening in this space where we all have to occupy those white spaces of what else can you do with securities that so far you cannot because it's actually in the traditional space. So maybe it's a more fluid way of doing lending or actually having one balance sheet for crypto assets and normal assets that you can actually use to do certain things. Or it's actually the benefit of actually having a cross-reference of a security that benefits then a customer relationship. So because I'm a shareholder, I get something differently from the customer. That those things all we've spoken about for years, but now it's about actually sort of bringing people to prove that out to make it not just like 10 to 20% better from a cost stack perspective, but really like orders of magnitude different from an experience set. That's one thing. The second thing is experience. And yes, UI matters and experiences matter and trust matters. But it's also equally that I think we need to talk about the friction points, meaning that, we can't have AML or KYC in 15 different places and uploading documents everywhere. It has to be something that works as smooth as Facebook Connect or some other trusted service where they're not the trusted service. So something that actually brings people to see this as a appreciative process and not something that just is as equally burdensome as the banking sphere is. So, and that's a challenge. That's a very big challenge because it's not easy to solve that, right? But yeah, that's sort of the three aspects I'm looking at.
That's good. That's a good answer. Thank you for that. And Derek?
Yeah, I think I went over, one of my slides was specific to this. It is tough to predict what's going to happen, but I think we have to first we have to rethink what our interaction is with investable part of the securities, because it's if blockchain as a technology is going to solve a problem, it's going to create new problems, but at the same time it redefines the way that we hold and manage assets. So, for me, DeFi is the most exciting component to this, the ability to have real world assets that we traditionally would have, but now be able to leverage them. I can stake my house in OV and, get a mortgage, right? And it technically could solve some of the other challenges that we're bringing up on this webinar, where some issuers may not want a tokenized component of their capital stack because the senior lender won't lend to them. Fine, I'll go to I'll go to a DeFi protocol and get the full thing. I'll get the full debt off of that, right? So I've completely eliminated, the too risk averse component because I understand the technology and I'm comfortable with it. So yeah, I think the ability to interact real world assets with DeFi is the future, and that's what I'm most excited about.
Thank you for that. Okay, so Niklas, if you could give your view on what the future for digital assets hold.
Sure. I think, I have to agree with everyone who answered before. It's always hard to predict, and there are a lot of challenges. But I do believe that, when we talk about digital assets, there are so many components that we already see companies engaging from various perspectives. And if we just take a look at, what ANZ is starting to do, they started to tokenize the Aussie dollar. Now we have, large PSPs like Checkout.com, WorldPay, many others, starting to leverage blockchain technology to make any type of payment, whether it's cross-border payments, whether it's merchant collection, payouts, much more efficient. And then on the other hand, we obviously have now companies that start to, whether it's, tokenized real estate, whether it's gold, securities, whatever it is. But I think the ultimate end game solution that we would like to see, because current financial system is very based on promises, right? If I buy a stock somewhere, there's a promise that I bought this stock. It takes some days until it arrives. It's just a promise that it's, all owned by me. And if we look into, whether it's going to be stablecoin, CBDC, and tokenized assets, if we can get to an instant DVP where I actually hold, the token represented in my wallet, it shifts, from just a promise-based system to actually physically, digitally, then me owning that part of the asset that I purchased. So I think, this is where we hopefully going to end up at one day. It's going to take a while. And if you ask me, if we take a look at what Philipp presented earlier, the slide with all the different participants in the actual flow today, it's going to go step by step, right? We're going to try to remove a counterparty and then another counterparty. It's not going to happen from today to tomorrow that everyone's going to say, okay, now we do it as the second slide showed. Did you have buyer and seller interacting automatically? I think it's going to be a testing what works, what regulators will feel comfortable with. And if we prove then that it works and it has benefits, then we're going to see the next step. So I do believe it's going to be a step-by-step thing, but we're going to get there.
Yeah, absolutely. We're going to get there. Thank you so much for that, Niklas. All right, I think that's about it. So yeah, thank you so much to all of you, the great panelists and presenters. As always, it was some insightful presentations, and it certainly helped clarify a lot of things concerning decentralized trading of tokenized assets. And to the audience, if you have any questions that didn't get answered, I believe most of today's presenters can be found on social media. So yeah, you can try to reach out to them on LinkedIn, Twitter, other social platforms. And yeah, lastly, I just also want to say thank you to all of you who attended the webinar, the audience, and also thank you to the great tech team and the moderators for helping making this webinar. I hope to see all of you in a month when we are doing another webinar, this time on ESG in relation to tokenization. So yeah, thank you for today and see you all soon.
Thank you.
Thank you. Bye-bye.
Thanks.
Bye.
Hey guys.
Thanks, you.